None of VPM Partners, Bob Kendall, or any of its officers, directors, employees, other personnel, representatives, agents, or independent contractors is, in such capacities, a licensed financial advisor, a registered investment advisor, or a registered broker-dealer. None of VPM Partners or its personnel gives investment or financial advice or makes investment recommendations, nor are any of them in the business of effecting trades or directing client equity accounts or giving futures trading advice tailored to any particular client situation. Nothing contained in VPM Partners broadcasts, on its websites, or in its written materials constitutes a solicitation, recommendation, promotion, endorsement, or offer by others described above of any particular security, other investment product, transaction, or investment. Copyright 2014 VPM Partners. All rights reserved. Terms of use apply. Reproduction, adaptation, distribution, public display, exhibition for profit, or storage in any electronic storage media in whole or in part is prohibited under penalty of law.
Good morning, everyone. Monday morning, lots going on. I was just telling Mitch right before we came on the air we should have had the music for 2001 Space Odyssey on, since that's where the market is right now. So we have penetrated the 2000 level, and there's a fair amount to cover today because there's things going on in the configuration behind the scenes, behind the curtain, if you will, that are continuing to signal the same types of things we've seen over and over during this rally. S&P is definitely leading the rally, and we'll go through in a minute. When you look at MDY and IJR and all the different classes and different asset classes, they're not participating. This is a completely large cap driven rally. Yeah. So got a fair amount of news coming out. I guess, did the new home sales come as...
They did. They missed. Consensus was at 430,000. The actual is 412,000. So pretty large miss, but the market doesn't care.
But it doesn't care because of Draghi's having a party out in Wyoming, and here the whole story today. And this all started. It was interesting. Squawk Box Europe came on last night. I was up a little later watching to see what was going on when I saw the futures up, and the first thing out of Steve Sedgwick's mouth, he goes, I have no clue why these markets are trading like they are. You know, the fact that it came down to that Draghi made the comment that he's worried about deflation, and typically Europe is really concerned about deflation, not inflation. And in this case, they're starting to become concerned about deflation. And the whole talk of QE, even though they don't really have some of the mechanisms to do QE, right after that, everybody started talking about that. Germany comes out and completely flat falls on their face economically. They're missed for the fourth month in a row. Everything's going down, just like housing starts here. Nothing's good. And all of these central banks, even Japan went nuclear on the QE. And they're not getting any growth. Their assets are growing, so that maybe this is maybe the class warfare that everybody's worried about should just shut up, because the markets are going up, and all the poor people are getting hammered. And it was supposed to be, they're trying to say they're doing the other thing around. And the bottom line is nobody's participating unless you own stocks, and that's some sort of assets, or we're going to drive the market. So Japan's not getting what they're trying to do. They just went, there was some kind of massive tax hike that is hammering their economy right now in spite of everything else. And that was the other element that came out last night, is that Draghi was talking about the European nations need to lower their taxes, which was an interesting theory. It's kind of a GOP theory, right? Lower taxes, get things grow. And, where did that come from? Out of the middle of socialism itself, and the core of socialist environment in Europe. So, all of this stuff, is this long-lived? I really couldn't tell you if it is or not. I mean, that's something we'll just have to watch. The markets are just exceeded just by a little bit the normal range. The 3-day range right now is 9.21. on the VPM range indicator. So we're seeing fairly low volatility, even though the market just kind of goes up. There was only one day last week we didn't go up, and we were down 0.20 on Friday. There's a little bit of backfilling, little profit taking on Friday, and that was about it. And this is all about the S&P. And when we go through the show here today, we're going to talk about some of the elements that, and when you start to look through the elements, the only thing that's trending and the only big index that we own is the S&P, and everything else at EEM. But when you look at EEM, it's so far off the market ever making a new high. It's pretty amazing. But all of these indices that have collapsed in and early in the spring are just rebounding. They're not really breaking out to new highs. And the other problem is when you stretch the rubber band so tight, the S&P has been a V bottom since we hit 1905. It's just been straight up, but it's being driven by probably by the top 25 stocks. I know Mitch has got some of those on his list today, and some things that we want to talk that are relative to your portfolios that we want to also cover today is really about the some of the top holdings within our system. And Mitch, why don't you mention what a couple of those are? I know it starts off with Apple's number one.
Apple's always number one, it seems like. Apple, McDonald's, Microsoft, Johnson & Johnson, Intel, GE, AT&T, Chevron, ExxonMobil, Verizon. Those are the top 10 holdings that we have across the board in our database.
Yeah, and so we want to discuss some of that stuff because we feel like that's probably more interesting to the bulk of you since it's widely held. But some of the things that are going on from an indices standpoint, I think, are even more interesting as the markets unfold. So, Mitch, did you have anything? Was there anything else to see? There was something else came out. The PMI services. Is that
PMI came out? That was also that missed. Consensus was at 62. It came at 58.5. And then we also had the Dallas Fed manufacturing survey come out. Consensus was 13.5. Actual was 7.1. So again, more misses across the board. The only thing that was released today that was a nice surprise to the upside was the Chicago Fed National Activity Index. Consensus on that was 0.2. It came at 0.39. So that was the only thing that came out today on an economic indicator point of view that actually was positive.
Yeah, and so like tomorrow we have durable goods, Case-Shiller, consumer confidence. There's just a lot of stuff that that's out there that my guess is they're not going to be very robust at all. And so what is it that these central banks are doing other than building a massive amount of debt to I'm not sure. It's almost like one of those things you've went so far down the trail, there's no way to get out of it. And they continue these same tactics, which doesn't appear to do anything, like I said, other than raise assets. And now, to the point, we are only raising assets in a very small group of assets now. So not everything is even participating anymore. So they're losing the traction. There's no traction in this strategy, but yet they continue it. And I'm not sure where this is going to end up, but these things always seem to end ugly when any of us do anything that we're not sure about what we're doing, and at the end, sometimes it could turn out good, but this continues to be the same story. So let's go ahead and go on to some of the look at the technicals here, and the first chart that I'm bringing up is the S&P weekly, and you can see a couple things. I brought it up without me being on there. So PPM1 is now at 0.27, which is back at trend mode, 0.32 and 0.25. So all three of these averages are back at trend mode, and it's also, as I mentioned earlier, it's the only index that, or one of the main indexes that VPM continues to own because it does have plenty of trending capabilities. And before I review some of the other asset classes, what I want to do today is actually go through all the spectrum of the different elements here, and we'll go over to the daily graph, and this is where you'll see this V bottom that came in. It just literally went from straight up since 2012 1905, and I'm going to bring up a whiteboard. You can just see this, but there's a couple things that I want you to also see here. Is that what I want us to see is this little, here's the V bottom right here, and we went up. Look what's happening. Momentum is not expanding across the board. Even though we made a new high, even though we're above this level that the great 2000 level, another barrier been broken. At some stage, we all know that when this happens, ultimately it's gonna be the end, and that's the way it's gonna happen. But you can see here on all of these arrows on the PPMs here, nothing's expanded. The only thing that did expand last week, we saw a continuation of the expansion on the 10 period moving average, or the PPM1. But you can see it's even turned down. So this is I guess one of these patterns where you're just not getting the expansion. You're looking at PPM1 at 0.29, PPM2 at 0.001, which is flat, and then 0.03. So nothing going on here. They're not picking up any of this price action above the levels where we're seeing here. And when we look at the values of this, you're looking at the PPM1, or I'm sorry, the 10 period moving average at 1971.16. We're 1954.47, 1964.07, and those are going to represent the pivot numbers in this pattern. And I could do some Fibonacci analysis, and we're going to come up with about the same numbers between 1968 and 54, I think, is the numbers that you come up with when we do that analysis. So these are going to be key points in the downside, and it'll be interesting to see how this pattern continues to unfold. Right now, like I said, we're not getting any sort of expansion whatsoever, other than the short-term one, which has already started to roll a little bit. It's still at trend mode, and so the key support is 1971. In the commentary last night, there's a couple things I want to discuss there, and I can actually bring these up on the board. You can see it right now on the screen. So the range for today is 1979, around off to 20, but 19 on the downside. The extreme is 1997.61, so we've exceeded that. And this range, as I mentioned earlier, is 9.21, and this is not expanding. It continues to contract. Today we've got just a touch larger range from so far we've been 91 to 2001, so we're almost exactly, we're 1020 on the range today. So on an average 3-day, it's really not going to make much of a difference. We're probably going to remain under a 10 number, which tells me there's some volatility coming in the next 2 to 3 days, and typically it's on the downside. So but meanwhile, as I said, and we'll go through this in a minute, these trends that are unfolding, mostly short-term, mostly driven by a small group of stocks in the S&P 500, the top 25 to 50 are driving this thing. Most everything else that looks like a mid-cap and small cap, while they have rebounded, they're not making new highs, they're not setting new trends, they're not getting trend levels. And Mitch and I both were doing independent research this weekend, looking at a lot of different elements like this, and couldn't find anything that was pointing out to anything that was expanding or contracting. It was just pretty much as it has been. So let's look at the weekly numbers, and this was the other numbers I wanted to talk about here, is the weekly expectations here. Now all of a sudden you see R1 is 1997.08. We've already taken that out. R2 is 2006.80, rounding up to the nearest number, and this is most likely probably going to be the range. I had a short term, and I'll show you where I got this in a second here. And rumors are I'm going to have everything I need for the new MarketMind release. Finally, software is always fun. What can I say? But so we'll have to put some things together to get information out to you. So you'll have this stuff I have on the screen, on your screen, if you want that to be. The the uh, the patterns that I'm unfolding here is suggesting we could go as high as 2025 this week. That is the extreme, and these are based upon a the VPM rangefinder indicator that gives you the ability which to do the daily ranges, and it and I also discussed in commentary, since we're coming to the end of the month, that there were some key numbers, and we've actually exceeded the extreme number for August, which was 1989, and that number has been penetrated. Obviously, we're about 11 points above that. We just now went back under 2000, 99.55. So you can't find the bag man yet to hold it over 2000. It'll be interesting to see how everything ends up. But the bottom line is we're seeing this whole pattern suggesting they're clustering again around 2000, and this one has 6. Let me show you let me go down to a much shorter level, go down to a hourly chart, and you'll see there's three targets here on the Fibonacci, VPM Fibonacci objective tool, and that is, see if I can get to that. Yeah, so the targets are 2001.84 on that pattern, high 2001.95, so pretty close. That's been met. The next range is 08 to 12, which I discussed in commentary, and this came off the very short-term charts or 60-minute graph, and this is of the cash. And so we're seeing that this pattern is satisfying these little stair-stepping targets that you see across the board, and now we've got they're contracting as well. So typically, as they're contracting, we're getting close to somewhat of a rollover. The PPMs are in a reasonable trend mode on a short-term basis, but they're even fading as well. And matter of fact, I am going to blow this up. I think there's something I can show you how these, yeah, to a degree, I can show you what's going on. If you notice the over to the far left, just above my head here, you saw that the 3 averages were expanding. Then you see them start to contract. We have contracted down very close right now, and this is an hourly chart, so it gives us the opportunity to see what an end of a trend or a top forming looks like. And so they get real narrow. What should happen is a momentum will come out of this PPM1, and then it'll start to roll down, and we'll see the markets move down into these ranges on a short-term basis. That's like 1983 is pretty much that bottom in the range, and that's also on the daily objectives where S2 was 1983.30, and that's a critical number. The market should close higher. If it takes out that number, then it would definitely be a lower close. But right now we're a little ways away from getting there, to say the least. That would increase the volatility. And with all the news out, I guess if everybody thinks about what's really going on, that they'll realize that economically things aren't good, not getting better. There seems to be a continuation of the loss of traction in the economy. There's some areas that are still picking up. We'll see when the numbers come out for the jobless this week. But we have GDP this week as well. So there's plenty that's going to affect these markets. And we're down to the last week or so of the summer, and we're going to have to get into full mode. We'll start doing 3 shows a week here soon and doing all of that. Let's go to, real quick, just so we can see what this looks like. I'm going to spin forward all the way to the monthly graph, and these numbers haven't changed, and they're not going to change because it's not all it's doing is moving the range, even though we've managed to move up a bit. 1.36, 1.47, and 1.0 on the trends from the standpoint of the monthly. So get very robust trends yet. I know I beat this one hard, but we're not gonna see this thing really start to decline until that PPM1 gets under 1%, so 0.9 something. Then that will be a warning sign. For right now, no warning sign. We will turn over on Monday when we get our first ticks on Monday. We'll be able to see what's going to happen with momentum, because while the markets have moved higher, there's not the extension or the momentum that's coming off. So this is a 10 period moving average, so you're still dropping off much lower numbers, so it won't take much to maintain momentum, but it won't take much for it to turn over either once we start to go below the last three bars are pretty close together, so there's some sensitivity that's going to happen. It won't take much for this thing to roll over at that point. The real quick look, and I thought this was interesting. I'll bring up I've got the hourly graph here. Let me go back and so I can drag this over. I've got it. So so if I pull this back over here, you can see the next cycle that's due is not until around the European Open tonight. So this particular cycle we're in now is likely to stay positive, and as long as we continue to get some stair-stepping type patterns, and this is the 1 hour bar graph, but it's also a 24-hour futures that we're looking at. So you can see this pattern. I'm just marking it out here. This has been the pattern. We had one break here where we made a lower low, but since we've made this low, we've actually got, this is very possibly the five-way pattern, and we should get something like this coming off. And this is an hourly graph, so that would tell us back to that 75, which would be back to 83 or something of that sort. So it's nothing dramatic. It looks bigger than it is, but all of this is pointing to this pattern, and it's going to be important now that we've been over 2,000 to be able to. I think I know it was the number on the commentary today was 1995.45. So we need to close above that. We cannot afford, from a technical standpoint, once we've done what we've done, to not stay above that level. So let's go to and look at the shorter term graph, and you'll see that the cycles hit pretty well. There was a low cycle coming in here. Looks like another low cycle coming in about 20 bars, so about an hour and a half from now, there'll be another low cycle, and then I wish I could see the times going forward, but pretty close to the close will be the next cycle on this 5-minute graph to come in. So it does appear that there's another low cycle coming. They're going to try to rally it back into the close, and if it fails, then you could see the market somewhere once again as we go into tomorrow. It doesn't look like anything's going to happen today from that standpoint. What we always do on this phase, I'm going to bring Mitch back on with me for a second here, and what we always also go through is through the database. Even though there's not a lot to talk about, we can kind of review where we are and what's going on there to keep everything rolling here. So we try to get through in this first half hour all the pertinent information on the markets and what's going on.
Yep. All right, hold on one second. Let me jump over to that side of the system. And let's pull up the dashboard again. So as you mentioned, Bob, I mean, there really wasn't a lot of activity to talk about. I mean, it may look like it on the stock side, but really it was a net move of zero. We had, let me just pull up my stats that I have on my end. We had 149 stock buys over this weekend, 35 sells, bringing us to a net increase of 114 stocks. So really just a very slight move on the stocks on the database. Not really a lot of consistency across the board.
Well, I want to chime in because if this thing was turning around, folks, if it was turning around by any means at all, what we would be seeing is we would be seeing all these trades coming back on, and they're not. And they're, we still are at 43 point something percent, I think like 60 something on the database. But the bottom line is these things aren't jumping back on like, oh, here we go again. That's not what's happening here. This is staying very, very narrow. It's 2007-ish from the standpoint of the configuration. We're starting to see that implosion of the database. The trends are breaking down, and then a very few stocks leading the way up. So if you're lucky enough to own those stocks, and you're lucky enough to own the right indices, that's where to be. Even though if you're in a buy and hold mode, it looks like you're getting some benefit from these other the IGRs and the other asset classes, but they're not really doing that. And I'll jump back. I didn't cover that, so as soon as Mitch finishes, I'll jump back and we'll look at some of those indices. Sorry to interrupt, Mitch, but
No, it's fine.
I think that's is pretty key to understand.
Yeah, and just to revisit that, as far as the long exposure right now, we're long 43.62% of all the securities within the database. So, I mean, just a slight uptick over last week. I think across the board, the total amount of buys that we had was pretty minor. We had 453 net buys this week across the entire database. But if we jump over to the mutual fund side of things, these composite assets, you'll notice there's virtually no activity whatsoever when it comes to all the different securities. I mean, it's just a very slight incremental shift where we had a little bit of buying, but when you really look at these different asset classes, there really isn't any sort of consistency across the board as to some sort of turnaround when it comes to these composites, just as Bob mentioned. So it's really just more steady as we go with the other activity that we've already seen, and it's just more of the evening out as other securities that had been largely bought in prior weeks have finally, the stragglers are catching up, and same with the selling side of it. Some of those assets, those groups, those sectors that had sold off a couple weeks ago, the stragglers that hadn't quite pulled back as much as the others, were finally exiting out of those positions.
Yeah, and real quick is realize that we're not the only ones seeing these stocks not rebound. All these money managers, and there's some great mutual fund managers out there, they're pulling back, rearranging their portfolios as well, and that's why you don't see some of these mutual funds coming back. If you're pure index based, like with some of the ETFs and maybe with Vanguard or something like that, they're just mimicking indexes and doing their best to keep their correlation as high as possible. But all these other guys are not doing that. They're managing the money. They're trying to figure out where they should have those things going. So
yeah, I mean, there was a couple talking heads on CNBC this morning that I thought they said it really well. I mean, yeah, we have hit 2,000, which that means something. However, just simply getting 2,000 with low volume, low participation, it really doesn't have as much substance as if we had some real volume within the overall market.
Couldn't disagree with that more.
Really?
The low volume is what's driving the market. It's not high volume doesn't drive markets.
Right.
That's what they always think it does. So the talking heads got it wrong. That makes me nervous. They're saying that. But usually I'm pretty much contrarian. I don't like them to ever agree with me. But the bottom line is the low volume. It's not. I've talked about this in past shows. I know we've done it on Process Warriors. It's not about how much volume pushes the market. It's the aggressiveness of the volume that's there. Because I've been in trading pits and there has been low volume, but the guys that want to own this stuff do not care what the price is, and they will buy everything in sight. And if there's not very much to buy, it goes even faster. That's what moves prices, because there's a one-sided volume, and it doesn't have to be a lot. So every time I hear that, I snap on my volume story. I've been fighting this thing for 30 some odd years because it just doesn't work that way. Typically, when you see big volume, it's not the end. It's not the beginning of something. It's the end of it. It's a climactic type situation where everybody has jumped
it's like
in.
Capitulation, right?
To a point, yeah, but it just doesn't necessarily have to be. There are times if you go through a volume chart on a stock, or anything, any indice, and you see the volume spike, you'll notice that most of those spikes happen at peak lows or highs, depending on where they come at, and then you'll see some distribution around that. And some of the futures charts and some of the things I use a rate of change of volume, not so much the relative. Understanding what the relative change is much better to understand volume than it is from a pure volume standpoint, because these guys, I mean, it's dog days, so they've been talking about this all the time, and we've moved up from 1,600 now to 2,000. Anyway, sorry to go on a volume rant, but there's no way I can't ever avoid that thing when I hear it. I don't want
I try
that
to get you going at least once per show.
and listen,
so
I this is important because I've spent so many years to understand these markets and the movements, and it's just impossible to base one thing, volume, which has nothing to do with price. I always say when they say it has to trade a certain amount of volume, then or otherwise I don't get the benefit of what the price did, then I'll pay a lot more attention to the volume. But it doesn't matter if 2 trade or 3 million. It matters what happens to the price and the aggressiveness of this. And many years ago, sorry segue, 30 seconds, we used to do seminars and we would simulate a trading pit and we would show how volume was not important. And there were 3 of us on my team that had all had floor experience, and we had unlimited accounts, so we could sell or buy as much as we wanted, and we showed how we could push the market and around. And we actually had a participation with a crowd, so everybody could buy up to a certain amount. We were trading S&Ps futures, and everybody could trade up to a certain amount. We had the best guy we did it for 30 minutes. Who made the most, we'd give away some prize, and we had a booby prize for the guy that lost the most. But it was really about understanding how volume, how emotions come into markets and all that stuff. Sorry for the side story, but
no, it's good.
I've been around this stuff too long.
Well, moving on, as far as activity across the database, one of the things that did catch my eye, and we've been talking about this for some time, we finally had a sell on GLD this week. So after taking a 9% loss on this, waiting for this ticker to finally do something, we finally exit out of the security at this point with a loss in place of 9%. I believe we're still long IAU on the same trade system, so that might be something good to pull up after we go through this. But when you really look at all the other different global markets, as well as the commonly held securities, like these indices here, there really hasn't been any further activity. No new participation across the board. I mean, really, we're just waiting for the dog days to end and for things to really begin to shake out one way or the other on these markets.
All right. Well, since there's not a lot going on, was there anything you wanted to cover?
No, I mean, the globe at a glance is just more of the same for last week. I had a positive week pretty much across the board. So.
Right. Yeah. So let's go back real quick, and then to keep things focused on what's going on. And I also want to look at the treasuries real quick. There seems to be. It's funny. We started off and there wasn't much going on, but now I'm digging into this thing. There's a lot to talk about, and I think going back over to TradeStation here, and let's take a look at let's do a couple things here and just go through. And Mitch, I might need some symbols to be able to get this done right, but
okay.
So I might holler at you for certain things. But
not going anywhere.
Let's go. I'm sure you're not. Okay, so that's good to know. So I'm going to go and bring up IJR, but when you look at this thing, this IJR is doing what we will see not too long from now on the S&P 500. And if you look at this, is on a monthly basis. I was just talking a few minutes ago on a monthly. We need to see PPM under 0.99. It's at point. Let me get both Mitch and I out of the way here. If you look at over here on the far left, and I'll bring it also up on this so we can see this. But the PPMs are, why does it never show up there? Hang on. Yeah, so anyway, it's not showing up on that screen. I forgot to turn that on. But anyway, the PPM is 0.57 on PPM1, 152 and 196. So, and when you look at this index here at the PPM, you see it's broke through its first and second derivative. The same thing we've broken on PPM2. We've broken through the PPM2 has broken through its first derivative, coming down to the second one. And on PPM3, the longest one, it's rolling over as well. This is not what a new trend looks like or beginning of something. This is a top. Okay, I'm going to be adamant about this. This is what a top looks like. It is not. This is not a new rally. This is how the top sets up. This is how it did it over in 2006 and 7, and this is how it always looks, and it will forever look that way. And So these are not the kind of momentum numbers you get. So let's go down to the next level here, and let's go to the on a weekly basis, and you'll see, hopefully it'll come up. There it goes. You'll see similar where we're flat on the 10, 0.7 is behind me, and 0.10. So we have no trend on the upside. It's moved up a little bit off of a negative number, but these are not trending numbers. And of course, hopefully I can successfully blow this up so we can see it a little better here. And let's see if I can consolidate it just a bit. So you can see here, this was the top right here at 114.28. We went down to 104, and now we are at 109, and we're a fair ways off of the high. And by the way, it's negative on the day. In case, yeah. So and now we're at 97.40 on the S&P. So we're seeing this thing trying to roll over here after printing above 2,000, and I guess the CNBC folks had their hurrah party of some sort, right? But this is what's going on here, and I think it's important to understand. And these are why you see the things out of VPM and what's happening. I know the S&P's going up, and that's a lot of benchmark, and it brings up a lot of anxiety. But when you start looking at the other assets, it's just not happening. And so, you all know we've been doing this show, just getting close to our 55 or 60th show that we've done. I'm not hesitant to call this thing like it is, and it's driven partially by database, all about process and understanding things. This is the same way I've done things forever and ever. In 2011, when the markets were ugly, I was talking about 1905 long-term objective. Guess what? We got to that 1905 to 1960 something, and that was 3 years before it hit. So there's the long-term stuff. This stuff is going bye-bye. There are no more numbers out here anymore, so you can only make up stuff at this point. So I'm not quite on Harry Dent's side, and the end of the world's coming, but there are some signs that certain elements are happening, and whether these end up to be long-term consolidations. If you look back at 2010, all 2010 was the beginning of a consolidation pattern. Went from 2010 to about mid 2012, and then we saw the traction on the trends, and pretty much from there, all the crazy volatility went away. We got normalization in the markets, and then we saw a nice trend, and that's why 2013 were so good. Now we're seeing some of the opposite things happen from that standpoint. So let's go into another asset here, and let's look at MDY. And MDY is a little bit stronger, but as we know, and we've talked about this a lot, is that the small caps have led the way as far as the market going down earlier in the year, and they've not really rebounded. And it's a great story to talk about if you're a commentator, if you're writing commentary, how the Russell has outpaced the S&P today, but in the end, it's nowhere close to these patterns. So we're seeing that there are some Fibonacci objectives out here on the MDY that maybe are worth looking at. The high target is 262.96, 272 to 278. We're currently at 260, so it's not a lot. It's probably maybe 2%, if that, roughly. Not even that. So there's not a lot really there, and as I've been discussing during the show, we continue to see a contraction of these, and then we're going to go through some of the elements of what we have on in like the global equity strategy. Here's EFA, not even close to what's going on, and I made a comment in commentary last night that maybe this is the tipping point. We're going to go to the international spreads here because they're important to understand what might be going on. And if somehow, some way, Draghi and these folks come up with a way to stimulate Europe, because right now, it's funny, the sanctions that are supposed to hurt Russia are hurting Germany a heck of a lot more than Russia. And matter of fact, Angela Merkel was on last night in Germany telling everybody there's no even close solution to the Ukrainian situation. So this thing is ongoing, and Germany's just getting hammered economically. So it's somewhat irony, I guess, of the whole situation there from that standpoint. But EFA is reflecting that. So what I want to do real quick, I'm going to jump over to our international spreads, and I've talked about these over and over again. This chart on the left, I'll blow that up. This is the EFA. You can see it continues, the U.S. market continues to outperform at the moment. So we're continuing to see all of these elements as they have been. The same thing with the emerging. Now this emerging pattern seems to be a little more reluctant as far as the spread goes and moving lower. So I'm still betting that when these spreads turn around, you're not going to want to own stocks here in the U.S. And it may not be that stocks in Europe are going up, but I believe when this thing rolls over, it's going to roll really hard. Just trying to figure that out when that's going to happen is tricky. As I said, as far as the S&P goes, with the monthly numbers like they are, we could be 2-3 months away from that mode. But it's certainly looking. If you look back, like we just went through the IJR, there's a lot there that you could argue to keep that going. Let's do one real quick here. I got IJR up here now, but let's click over to the treasuries right now. We are 239, so we're just below here. I'm going to try to consolidate this a little bit so we can see. Only objectives that are out there that are valid right now are on the downside. So when we look at the Fibonacci, the VPM Fibonacci target, we're looking at 227 to 201. So there's still a lot of potential downside on the treasuries, and the big debate has been who's right. Are the bond traders right, or are the stock market traders right? And we'll have to see how this all plays out. But as I said, in the treasuries, I still believe this is a shift of capital going on into our bonds, just because the Bund is 1.02 or something. It's ridiculous. I think there were some new lows happen. I didn't review that before I came on. But the bottom line is these things are still under pressure, which I guess is a good thing, but I'm not sure how this all works out. I know if most of us were asking, including looking at I thought rates were going to go down for the first quarter of this year and then rebound by this time as we come into third and fourth quarters. And guess what? That's not what's happening. And it doesn't look like that's what's going to be happening either. It's definitely looks like further downside pressure. Maybe when this particular run finishes, then we'll finally have higher rates. And just looking at all the things that happen in Jackson Hole, there has been, I guess the comments by Janet Yellen are just, I guess, short of ridiculous. I don't even know what to say about it. Just looking at, last Friday everybody was hanging on, hoping that there'd be some reviewing of something new, and there isn't anything new, and they just don't want these rates to go up because I think it's the realization of what we already know, which is that it's going to affect things fairly drastically. And the markets will take control at some stage, and there'll be nothing that any central bank can do, especially on the currency side and those type of things. So anyway, from treasuries, still lower, could go as low as 201, 227. There's another 10, 12 basis points on the downside here yet. So we're just not seeing any type of signs that it's going to go up. There was several a couple months ago, but those quickly faded. We got up to, I think it was 268, which was right in a resistance target zone that it had earlier. That's how it finished out. So real quick, I'm just going to bounce over to the daily graph here on this, and you can see we spiked down to what, 230, what's the low here? 230.05. So we get down to 230 briefly. So maybe we'll get a retest of these levels, this 227. Here it is again over on the right-hand side, the 227 and 221. So there's some short-term objectives off the VPM Finder, pattern finder, that is telling us that those things are going to go down. But for right now, that's, it looks like sideways. Maybe when this is completed, we'll see something different. But as long as, especially if Draghi is going to try to do QE, try to keep rates down, then you're going to see a continued flow. And at least if rates do go up, you're talking maybe a quarter of a basis point, a quarter of, 25 basis points or something like that, pushes back into 250, 260 range, and that's going to be about it, because there's going to be plenty of demand for treasuries right now, which makes it pretty good for financing the debt. I think I had the debt calendar on. We're about to turn 18 trillion right now, and counting. So anyway, the bottom line is that's what's going on there right now. So I'm doing a pretty good job just taking over everything today here, Mitch.
That's fine. Keep going.
There's a lot of stuff out here that I think that is pertinent to what's going on from that standpoint. So we're seeing. I'm going to bring up the webs real quick. I call them, and we're seeing. This is a 1 minute graph on the futures, and we're seeing some pretty good pressure coming in. They bounced a little bit off this recent low, but there's some pretty heavy selling coming in right now. They're just ripping through this stuff, and so all of a sudden, the enthusiasm of 2000. I talked about this many, I guess, before when we went through these numbers, but the bottom line is, typically when we go over what we call the figure, or the round number, 1900, 2000, all those numbers, as we get above those numbers, the markets will usually trade off, and they've went as low as 1905. So I talked about it several weeks ago, was the 1991 high we had, and we went all the way to 1905, and now we rebounded and made a new high. Is this rebound, is this the final print of this rally? And a lot of times we'll see it go up above there and will come down fairly hard. I can see easily 85 to 79 on the future, not on the futures, but on the cash markets right now. It'd be very simple for it to do that. We'll see how these cycles roll in as we come in through today, whether they can keep that bid in the market where this is a lull in the market, a mid-session lull, and then they'll get a rebound, try to run them into the close. If they fail there, you could see a lot of folks bailing out. There's nobody excited about buying at S&P 2000. I mean, just do some soul searching for a second. You're not going to come up with the answer. I can't wait to buy this thing at 2000.
It sort of reminds me of NASDAQ at 5,000. We got up to that nice round number of 5,000, and that was the last of it.
Yep, and yeah. So, matter of fact, I joked that maybe the NASDAQ has to go 5,001, and then everyone will realize how ridiculous, because it was almost that we never thought we'd see 4,500 on the NASDAQ. We're looking at 4,553 right now, and it's. The bottom line is, it's going to be interesting to see how all of this plays out, because, like I said, these indexes are heavily weighted. They're all weighted, cap weighted for the most part. The Dow Jones has the Dow Jones divisor. I didn't hear anybody talking about Dow Jones being over 17,000. I guess that wasn't interesting. I think it's been over there just a little bit before, but anyway, the bottom line is these indices are definitely got a lot of things going on with them, and primarily the elements that are of the top 25, top 50 stocks driving these things. So see, I want you to see this. Let me do one thing here real quick so I can.
Yeah, it looks like we're hovering right at the extreme for the day at this 1997 60 level.
Yeah. Yeah, so you can see here, this was the drop off when we were talking earlier in the show. Uh, this market's dropped pretty hard, and we've seen a reversal on the hourly chart after penetrating 2,000. So this is that cycle that comes in. It's not until late tonight. It's going to be interesting to see, because I think we'll have to see. My opinion about the whole comments from Jackson Hole and Draghi and this whole little blip we got in Europe, that there's no substance behind it, because it's just that. It's just rhetoric that came out of a comment. No action's been taken. Nothing's really happened. And at some stage, until there's some action that comes out that proves that can happen, it's all, I guess it's smoke and mirrors at the moment. And it's possible that everybody will wake up and think that. I suspect as we come into this cycle low that I have over here on this 5-minute graph here, as this comes into this period over here, we're getting a lot closer here. We should see a rebound. That rebound can't make it to a new high. Then the next cycle low will be a low. So we could see this thing rolling a little bit here. We'll have to see how the numbers. It looks like they spiked out a reasonable amount of numbers. And matter of fact, this is pretty important here on the hourly graph. Let me bring that up. So see if I can get that to expand out the other way. So I want you to see this. You'll see this big giant spike down right here. This is pretty typical of a low of the pattern from that standpoint, and we'll see these big spikes. So as I suspect, we should see it firm as we come into close. So we got 8 more minutes to go. I guess if we had to, I guess probably to do one stock, the number one stock, although I haven't looked at this chart here real quick. I accidentally clicked on, so we'll talk about it. But these are what I call the webs, and when we get the TradeStation stuff rolled out and going, we'll be having some shows for those of you that are interested in seeing some of these technical indicators and things that I've built over the years. But I talked about, this is where I have the VIX, and the VIX all of a sudden got down to 1150 again. And now all of a sudden we're at the phase where this market's got nowhere to go on the upside. So this kind of confirms it. We're starting to see some crossover of the webs, and this pattern here, usually what will happen, we'll start to etch out what I call a diamond top, but that's for another time. So, but we are seeing some of the spikes here in volume. These are the volume rate of change. So it's the change. So we're seeing that it's increasing as we hit this high, and this is on a daily basis here today. So this is an extreme number. We really haven't seen this. And so, as I've talked about, 3-day indicator is telling us that there's a potential volatility spike coming, which is typically in the adverse direction of what the trend has been, the short-term trend. So that tells me there's a possibility of seeing some downside on this market. And as Mitch pointed out, we're bouncing around this. I guess we got through the 97.60 number here, so we're starting to inch down just a touch more as the market goes. So you can see here, back to the 1-minute graph, that we're seeing some downside, very close to punching out the lows here, and that low on this chart is 93.75 on the future. So we're 2 ticks above that number. So breach of that will send this thing a bit lower, and we're seeing that the momentum even on the 1 minute is starting to get pretty weak. And one of the things here, if I get out of the way for just a second, that you can see when you have a real-time data and you have, this is showing the bid ask, you can watch the time in sales, and when you see they're right now buying off of the offer side right now. So it just went through that number. So now all of a sudden we're starting to try to see a breakout, or at least move back up into the pattern that we've seen. But all of this stuff, there's good support and resistance on both sides. This chart down in the bottom where I have my cursor right now, this one side is the bid side, one side is the offer. So you can see that by the time you go 3 or 4 ticks out, there's substantial amount of volume there. So typically what they'll do is run down into that volume location there. So we really didn't get into a lot of stocks today, but I think for the last hurrah for the session here will be for me to go through, and we'll at least look at Apple. And of course it made history itself last week, getting over whatever the new highs here. They made new highs. So let's go over to chart where we can see that, and let's put Apple in here. And here you are. What's our model we have on this? 3.2, I believe.
Yeah, give me 1 second. Let me pull that back up. Just was bouncing around with it.
I think it's 3.2.
I believe you're right.
Maybe not. Maybe it's 1.2.
No, it is 3.2.
It is. Okay. So I'm not sure.
Yeah, we got in back on November 4th of last year at 74,443. We got a nice 36% profit on this.
Right. Are we logged into VPM2? Oh, we didn't, did we? Yeah, we did.
We are.
Okay, good. Yeah, so taking a look at this real quick on VPM.
AAPO.
Yeah, I know. Dyslexia, folks, sorry.
That's an easy one to mess up, though.
No, nice. Now I got way too much going on here. All thumbs all of a sudden. All right, here we go. So here's what Mitch was talking about, and one of the things that we're seeing on this stock, you can see that we saw some adverse excursion, but it kind of went flat and then it has surged up. So now we're seeing this thing up. What's our net gain here? We are up 36.54%. So this thing has, I guess if you stuck your head in the sand in 1999 and bought this stock, maybe you're better off. They would have scared you a few times. There's been some pretty good dips in here, but this from a trend following standpoint, there's a nice trend in here. We've got really strong numbers on these PPMs, and that's the thing I wanted to point out here real quick. And I'm just going to take this off for real quick with 3 minutes to go here. But you can see the other thing, the same thing is happening on Apple that I'm seeing everywhere, okay? And what I'm seeing is that these objectives are there's no further objectives above these patterns, and we're seeing everything moving into whatever their objective is. The S&P, all of this stuff is continuing. We're continuing to sell off a bit on the S&P. We're at 96, 98 now, so we moved a little bit lower. But here's the high target is 115, which we've met. 102 to 104, which I guess is times 7, right? They did a they did a 7 to 1, so you're looking at 7. That's 728 on the stock, and the way that we still kind of in our mind is locked in. But this is the stock's getting pretty close to its end, but we got good positive numbers. I mentioned 0.67, 0.21, 0.27. So I guess that's about all the time we have. I'll bring up the 1 minute chart that we're looking at here. So it's just kind of waffling around this 93, 75, 50 level is the low. I suspect that this thing will firm up from here, and as we go back and look, there should be a low of this pattern come in, unless we get back probably below the 95 number. Let's see, where's my daily numbers? Yeah,
95.45.
95.45. We get back below that right now, then that's gonna suggest there's some problems. We need to stay above that number on the close to be good. I'll cover that in commentary tonight. But the whole bottom line is that that's an important number intraday. Now that we've been up here, and it does appear based on the 5 minute futures and that we should see a bounce in the close, and we'll see what kind of bounce we get and how far it go. It's broken a little further than I think it should have to be able to print a new high by the end of the day, but certainly it's a narrow enough range. It's not that far. It's 4 handles away. So it looks more dramatic on this chart on the right than it really is. But typically when you get those deep corrections, it takes longer to get back. So this could move up into overnight into the some sort of resistance as this hourly. I was talking earlier about this hourly cycle that's coming in later tonight. That's going to be the point in it. Like I said, it coincides pretty close to, matter of fact, it's almost exactly, I think it's a half-hour difference from where the European Open occurs tonight. So we'll have to see. Europe's still excited about everything they were excited about last night when it all comes to an end. So that does the show. We will be back on Friday, and as we continue the summer cycle, but we'll make some announcements on what we're going to do, and we're going to start doing the Process Warriors and lots of activity around our little internet TV show. So thanks for showing up and taking the time to listen today. We really appreciate it. We shall see you on Friday and talk to you on commentary. Thanks again.